Okay, so the winning streak is over, but was it that big of a bearish day? So we're going to take a look at today's move, what the indicators look like. Have we had enough? Because last time we talked was Monday. Was yesterday's rally a breakout rally? Was it enough to really solidify the new intermediate trend, something we were looking for on Monday, or is that still a big question mark? So we're going to take a look at that from what these indicators are telling us, where we are relative to some of those important support and resistance levels we talked about on Monday, and what we can expect to see going into the end of this week. On one hand, and what we need to see for either the bearish trend to continue or what we need to see by the end of this week for this bullish trend that's just kind of starting to really get hold and take off to the upside. So that's what we're going to talk about in today's trade. We had some really interesting moves today in other asset classes too, especially in the bond market and gold. So we're going to talk about what that means, right? Those moves. What does that tell us about overall investor sentiment? And then our trade idea is a stock that's had a really good rally over the last few weeks, approaching resistance, very similar to the rest of the bond market. We're going to take a look at a speculative trade on that. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, March the 23rd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. We can see a little bit of a down day today, not too dramatic. We did close below yesterday's low point, but again, nothing too crazy there, 44.69, 44.56. Not a big range. It was not above average, so it wasn't a big down day. The near-term line actually stayed in bullish territory while the momentum line dipped to extreme low levels. That's a little bit of a red flag. And we also dipped back below that 2.5% mark, which is also a little bit of a red flag. But again, nothing, it's like we said earlier this week, by the end of this week is what really matters. So yesterday's rally was fine. Today's drop is not that, crazy. It's all about how we finish the week. Are we going to finish up at 40? Essentially, the question now is, considering at 50%, are we going to finish closer to 45.50, or are we going to finish closer to 43.80, right, or 85, or whatever, whichever of these lines? That's the big question. And right now, we're still kind of in the middle where we were on Monday. It's the same thing. In fact, we kind of talked a little bit about how this whole week might end up being a pretty much of a doji week, especially if we finish at the 50%. Which also would not be the greatest thing either. The intermediate line is in the bullish territory. It's not above 80. Keep in mind that if it peaks here, that's going to be a very bearish intermediate peak. If it peaks without getting above 80, obviously it would be a lower high point. So watch that near-term decline and see how far it gets. If it's your typical near-term decline and basically gets 38% retracement, the near-term line dips into this area and then turns back up quickly. Boom, we're bullish. We're on a bullish trend now at that point, and things are looking really good. The Nasdaq 100, if you see here, it's the intermediate line's also above 60, so it's bullish. Again, a little bit of a bearish candle that we did not get back below. So yesterday we closed back up. We closed above this resistance, 38% retracement, 23 of the big post-COVID rally. So big resistance here from a Fibonacci standpoint. We closed above it yesterday. We so far have held it. We didn't close back below it. So that's a good sign from today's move. The momentum line did not drop as low, though it is relatively bearish, did not get to extreme lows. And the near-term line, like the S&Ps, is still in bullish territory here. Then you look at the Russell, and it's a little different story. So the Russell was a little bit bigger of a close. Still did not get above average on the range, but still a little bit bigger closing below the last couple days worth of low points. The intermediate line did get above 80, but just barely so far. Obviously, would still be a very significant lower low point, as we did not get above the 38% retracement on the Russell like we did on the Nasdaq. We are also not back below this 23% either. So we're not quite there, though the near-term line did come out of bearish territory. Bullish territory, and is right at 40, right at the cusp of entering bearish territory with an extreme low on the momentum line and back below 1.5% above the moving average. So a little bit more bearish. Like we've been more bearish on the Russell when you look at the relative strength here the relative strength line of the Qs relative to the Russell 2000, you can see we've been pretty much going up for the last few days. The Qs have been outpacing the Russell 2000. So the Russell's been more bearish on a short time frame, and that's why our near-term line is much lower here. And again, like I said, closing below pretty much 3 days worth of lows with today's, and barely below that one, 2054 to 2052. When you take a look at the long-term chart, it still looks good. In terms of a bullish candle, we're still above the 10-week moving average, so we still got the green arrow. Still have a rising PPO, positive differential. Looks great there. So same thing here, and the same thing to a degree on the Russell. The Russell did, however, get the red arrow. Now we've got 2 more days left, so we'll see if that holds by the end of the day, by the end of the week, excuse me, by the time we close on Friday. We do not want to see a red arrow if we're going to stay bullish on these indexes. All the major indexes here, sorry, this chart here, all the major indexes got the MACD rolling over. So all of them. The Dow had already had rolled over, but now you have the MACD dropping on all of them. You still got 3 green arrows, so we're still light green shading. It's a good, if we can finish the week with light green shading, that would be a long time frame. That'd be a very, very good sign. So we're not going to get a green arrow on the MACD or the stochastics by the end of the week. They're too high. So, or red arrow, excuse me. So the only red arrow we're going to get is that moving average. So it's really important we finish the week above the 30-day, moving average. When you take a look at how far we are, I mean, that's how far we are in the S&P. So there's a good chance. Remember, it's only less than 2.5%. We talked about in our class today that it's not a bad thing to get a 1% decline. You can get plenty of 1% declines in bullish markets. You don't typically get a whole lot of 2% declines in bullish markets, or 1.5, 1 3/4. So only at 1 1/4 is not bad. That's not a bad drop considering we've had 5 days in a row, especially when you look at the SPX. We've had 5 days in a row, 5 out of 6, 1% gains or higher. The reason why SPY wasn't 1% is because of that dividend payment. The implied volatility dipped below historical. That in the past can signal a low point, developing. So that's something to monitor. A little bit of a gap there. So that's not bearish, right? Bearish would be closing back below 2%, and we didn't, or at least 1 3/4. In that area, 1.5 or more, and we didn't. Staying at 1 1/4 is actually good. So we're not bad, and it would take a 1.5, 2% drop in the next couple of days to get back below the 8 and 7. Remember, the 8 and 17 have crossed above the 30. That's a very good sign. So getting back below the 17 is what changes things. Pulling back to it's not bad. It's getting back below it is what changes. So we're going to drop, right? The MACD is going to pull down. The histogram is going to pull down, even if it just pulls down like that much, and then we rally back up. So the MACD itself is going to catch up. The moving average is going to catch up to it. That's not the issue. The issue is whether it breaks below the moving average with the price breaking below the 17. And the nice thing about the S&P, unlike the other indexes, it's actually above its 38% retracement, further than the others, and it's above the point of control. When you look at the Qs, it's also above the 38%, but not nearly as much. It's barely above the 50 right now, so we'll see if it holds. See, the SPY, we were back above the 200. So, again, tomorrow is really, really important day to see whether or not today is just by itself, one day exhale, or whether it's a sign of more to come. You can see getting back below the 17-day on the Qs would also be getting back below the 30, as well as that point of control. And then IWM, we are not close to the point of control, and we are a lot closer to the 17. And we're not, the MACD is not nearly as positive. So the Russell has been a lot more bearish, and it's kind of so far has been holding that resistance there at the old high points. And again, like I said, well below the 200-day moving average. And we'll see if it ends up. And like I said, did not get above that 38% retracement or 23 of the long-term post-COVID rally. So a little bit more bearish. Getting back below 23% would also be, getting below the 17 and the 30 would be getting back below that 23, and that would be relatively bearish there. So with that being said, that's that's what's standing. That's what we need to be watching for the next couple of days. The DMI is also setting up for what could be a bearish turn, right? Because your negative index dropped below 25, but not below 20. The positive did get up above 25, but just barely. Is already back a smidgen below it. So we don't want to see, this kind of move where the positive gets barely above 20, the negative dips above 25. Excuse me, the negative dips below 20, and then they reverse, right? Because we end up reversing and getting a new lower low, and that's we're setting up for that kind of pattern right now, with the positive getting barely above 25, but already reversing. The negative getting a smidgen below 20, already reversing. I see it's done that before too, right there. So really, really important that today is pretty much all the weakness we have for the rest of the week. Same thing here on the Qs. It's the positive indicator kind of hitting the ceiling of its bearish range. The negative indicator not, still above the floor of its bullish range there. When you take a look at the Bollinger Bands, you can see that we were in the upper quartile. We dropped back down out of the upper quartile, but still in the upper half, so it's still okay. The Qs also dip back into the middle part, and IWM is even closer to the midpoint. But all of these dipping back out of the upper quartile. Remember, we don't get a trend change until you break 100. We didn't break 100 on this one. So if we get a nice little easy, 1, maybe 2 day decline, and then start to bounce back up maybe on Friday into next week, and then break above 100, very, very good sign. But so far, we're kind of holding resistance at the ceiling of bearish ranges for a lot of these indicators. You see it on the RSI and the CCI too. Resistance in the bearish range is 60 and about 150, 100 to 150. That's what S&P has held. So far, the Russell has held. So far, the NASDAQ has held. They've all held these resistance levels, these ceilings, as we've seen. It's already done it. The Russell did it twice. Once here, once there, and this would be the third time if this ceiling ends up holding and then breaking, potentially moving down to below 40. So really important that we break through these ceilings here. Take a look at the short-term charts right here. Oops, not this one. It'd be this one. Take a look at the short-term charts. Again, we did get the higher range, and that's good. I wanted to show this stochastic indicator. This is where we are relative to that 4-week range on a closing basis. We're in the upper quintile. That's a good sign. The average of that 20-day average of that close is just barely getting above 50 and still not above 60 yet. So again, not out of the woods yet. Same thing with the NASDAQ. It's great, but we're not above 50, much less above 60. And then the Russell 2000, we did get above 60, right? And so again, we need to really hold this. So we need to kind of stay in this upper quartile and really kind of hold this Arun breakout that we've been seeing, right? With now the positive or negative indicator getting. This is a good sign. There are a lot of good signs developing. Not so much here because it's not below 30 yet on the red line, which is the 4-week low point. It needs to be further to the beginning of the 4-week range instead of to the end. And the S&P also, it's down there. See, that's the 4-week low point. It's at the beginning of the 4-week range. This is a good sign. It's a really, really good sign to see it. It's not 100% because nothing ever is, but it is a good. I mean, it's easier for this to stay down here, and really signal the beginning, the breakout move that we're getting. So, again, we need this kind of pattern here to form over here, really as early as tomorrow, because we don't want to see another 1 or especially 1.5 to 2% drop tomorrow, because that pretty much nullifies all this. Will pretty much nullify the quasi breakout that we've been getting on or at the end of this past week and then yesterday, especially on the NASDAQ 100. Let's take a look at the moving average, the volume and the trading range. Again, we talked about how low that was, 4.78. The volume at 78 million. Those are really low numbers. 78 million's way down here. 4.78's way down here. So we're bringing these lines down. The problem is we're still below moving averages, especially with like the Russell and the NASDAQ. We're still below 200-day moving averages. So we don't want to see us getting so low already. I mean, that's kind of typical of heading into resistance levels. As it appears we are heading into resistance levels, and when you head into resistance with smaller volumes and smaller ranges, it's a good sign that resistance will hold, and you expect resistance to hold until it doesn't. So until you get a good, at least average or more volume range breakout, especially if there's a gap involved with there, through that resistance level. That's kind of what we really need to see, ideally by the end of this week, if not early next week, to get a breakaway type gap that we can feel really confident about not filling for quite a while. Volatility is kind of showing an interesting pattern. It's not dropping anymore. We've hit down to this level. We're basing just under this 90% mark. Again, suggesting that it's having a hard time getting, really strong into bullish levels. If you take a look at the daily version of this, again, this is kind of where we're at. And when we're bullish, you really break down strongly into these bullish levels, especially below 85. That really solidifies a breakdown. Obviously, by then you'd be breaking below 20, which is also something that we need to see, and we're just not there. In fact, we're kind of stopping at 23.5 right now. So again, by the end of the week, let's see a little bit more of a drop towards 20, a little bit more of a drop, ideally below 85, and then we could feel good about, we're really solidly into this new bullish trend, this new intermediate run here. So I don't expect that to be the case. That's what I'm watching for to see if I need to change my expectations. But again, as I told you before, I expect resistance to hold until it doesn't. I expect that we'll get another leg lower to the downside. And it looks to me as if we are heading into resistance levels with the type of moves that are very typical of resistance holding. But you see what I'm going to be watching for to change those expectations and to change things around and being a lot more bullish. Until then, this is a really, really good opportunity for some bearish trades on a potential new leg lower to the downside, as you'll see here later with my trade idea of the day. So with that, what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. And two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you from today's video? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, come over here and check out some of these things on the right. Click on this icon right here. It takes you to our Market Outlook live page at 3:30 Eastern Time on Monday, Wednesday, and Fridays. On this page, I do a quick 10-15-minute video. I review all the trades that we've done in prior Market Outlooks to see whether we should stay in them, get out of them. Then I also put on today's trade idea already today before the market closed. I put it on this page as well. So again, you can check out today's right here. You can check out other archives and then come back on Friday and watch the Market Outlook Live again at 3:30 Eastern Time on this page. You can also get to it by clicking on Market Outlook Live Trade Review in our main menu. Come down here, you can see our upcoming classes. Click on View More. That takes you to our calendar. You can see all of our upcoming classes and all the recordings going back now. Like Brandon said yesterday, 4 years ago today, we started teaching classes. So we got 4 years worth of classes here, recordings. Come over here to this icon, click on that heart. Look at that, 100 likes. That's the first time in a long time I've got triple digits on here. So thank you very, very much. Again, that helps us so much when you do that. So click on that icon, click that like button. Come over here, click on this thumbs up icon. It takes you to this page. 200 people reach is the highest number we've seen in a long time, that I've seen in a long time too. Again, it's because of you all clicking on that like button. So the more you do that, it really helps us out a lot. It also helps you because Twitter and Facebook promote content on your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. You can do it right now even. All right, if you take a look at what's driving the price action today, you can see commodities had a really strong move to the upside, and then bonds really took off. So bond yields started the day a little down, but they really fell by the end of the day, and bond yields took off and gold took off. The dollar didn't drop, so this wasn't an anti-dollar trade. This was a risk-off trade. As you can see, equities pretty much finished at their lows of the day. Real estate also finishing, interestingly enough, at the lows of the day. Emerging markets, which have been more bearish than other equity asset classes, holding up much better than what we saw in some of these other areas. Let's take a look at some of these asset classes and what they look like here, especially TLT. Remember, TLT had really dropped pretty sharply, looking like that might be kind of the low point. Big move to the upside, over 2% rally to the upside. Again, below moving averages, so you're going to get that kind of a move when you're especially that far below the 8-day moving average. The MACD is really low. When you look at the directional movement index, which is really hard for it to get too extremely low, yesterday it did. It got down to 14, so it got below 15, which you can see it's pretty rare for that. I mean, we did over here too, and they got a cluster on that, and then we rallied. So we'll see if that we end up getting some kind of rally here on TLT. GLD kind of doing the same thing. Actually came down to moving averages and then bounced back up today. Let's take a look at that 30-day moving average there, getting back above the 8 and 17. The MACD had dropped down to 0, but did not get below 0. The histogram's already rising. So it's looking like we might be kind of forming a low point and maybe making a new leg lower. Again, probably filling in that range, but just with, and you can see it's kind of a long upper shadow, but doing it much slower than what we did last time. And there's going to be resistance at the top of that candle, but it doesn't mean we can't trade inside of the range of that candle. So it appears that that's what we may be seeing here. The dollar, like I said, did not drop today. It's still trying to figure out what it wants to do here. So we're on this bearish convergence for the Euro US dollar. The MACD is above its moving average, but we are not above the 17-day. So it's really kind of converging. This either does one of two things. We either go for a long time and finally reverse and get going, which didn't go too much there. Same thing over here. We finally reverse and get going to the upside with this divergence with a good strong move. Or we roll over and get a new leg lower to the downside, which we're already below this 78% retracement. Let me show you where that retracement comes from. It's this bullish rally that we had on the dollar in 2020 post-COVID up to its early 2021 high. So we've been the euro, excuse me. We've been dropping. We dropped below that 78% and so far holding, and puts the 100% level at risk, of being touched, if not back through that level, which would be significant for the dollar to be that strong. This is that really long-term downward trending moving trend line that we have coming all the way off that 2008 peak in the euro. We peaked again in 2014 as the dollar really took off. And as of right now, you can see that 62% retracement of this big, which is even a bigger rally if you have to go back the 20 years to this rally here, the 2002 all the way up to that level. You can see we're trying, it's trying to figure out whether it wants to get back to these lows. Pretty much all-time lows, 15, 16. I mean, not all-time lows, but for the last since the 2009 bull market started, it would be the lows for the euro relative to the dollar. So trying to break back down below that trend line and then staying down. So really important resistance levels for it to get back up above around this 114.25 level, because that would get back above the trend line and back above these Fibonacci retracements too, and get back towards the last year's highs. Which, if we were to do that, would be pretty darn bullish for the euro. Would be bearish for the dollar, and that incidentally would also be really bullish for commodities, which are really bullish right now, right? I mean, you can see the golden cross on the weekly chart, so we're well above the 200-week moving average. In fact, we might be as far above the 200-week that we have been. I don't know how far back I go on crude oil. Let me see how far back this contract goes. Here, let's go. Max available. So it does go back to, it looks like the mid-80s on this data that we have. Let me get rid of that drawing. And then I'm going to bring on the moving average here, the PPO, and then go how far above this 200-week moving average we are right now. So if I were to click on that and hit apply, we are 94% up above this 200-week moving average, so almost doubled And the last time we were around doubling the 200-week moving average was in 2008, right? So that kind of gives you an idea of just how bullish we are. I mean, we are pretty much as bullish now on crude oil as we were then. And we're not very far away from that $147 high. But to give you an idea of where we are on a relative basis compared to then, if I were to go USO to SPY and then go back, USO to SPY and then go back those same 20 years. So I can get that 2008 peak on here, and we'll go to a weekly chart. So we're nowhere near, right? So USO was 9.5 times SPY, almost 10 times SPY. Right now, we are not even a quarter of SPY. So now that's, there's some reasons for that, the way it works. So this is the same thing, but on with SPX instead of SPY, and then that the actual futures contract price. And again, we are, we are really, really low at 0.025 relative to where we were even in 2014 when things kind of hit the fan at 0.055, and then of course in 2008 when it peaked about 5 times higher than where we are right now. So even though we're close to the absolute price, we're nowhere near that same price relative to like other asset classes. And even if you look at gold, the futures contract for gold as well compared to crude oil. Again, in 2008, we were at 0.15, and right now we're 3 times, that's 3 times higher than where gold is. And so you could make the argument that you can't really compare crude oil to commodity to equities, but you can compare it to gold. It's another futures contract. It's a tangible physical asset class. And again, even though we're close to the same price on an absolute basis, nowhere near the same price relative to another asset class when you put it in those kind of terms. So needless to say, if the dollar, and this is how high we are right now with the dollar, as bullish as it is. Remember, the dollar right now is as bullish as it's been, right? Again, going all the way back as far as this, as we got data on this particular ETF. Imagine if the dollar was down to 24 on this. That's, where's commodity and crude oil going to be then? As considering how high it is with the dollar hitting up against some resistance here off of a nice good rally it's had over the course of the past pretty much 12 months. All right, let's take a look at how the sectors are doing here. And imagine the inflationary levels that's going to have when the dollar actually starts to fall. Let's look at the how the sectors did today alone. The big mover to the downside was healthcare. Healthcare and financial stocks really ended up down nearly 2%. Energy stocks, on the other hand, were big outliers to the upside, along with utilities. So safe haven there, and then energy kind of being a safe haven in terms of like very low margin of safety because it doesn't nearly have the gains. I mean, really, if you go back to since really COVID, if you go back to the COVID low point, which I think is about the same time frame 2 years ago. So COVID low point here. So pretty much the same time frame. Energy, pretty much is up 200% off of that COVID low point. Was not the case going into that Halloween low on 2020. It was actually way lagging behind. Go back even further than that to the March 2009 low point. So this actual bull market that we've been in for all these years, you can see energy is a huge underperformer, right? Really, really huge underperformer. You could say too, we can come off of the 2018 low point, the Christmas Eve, the Christmas Eve of 2018 low point, and same thing. Energy was energy was negative going into the end of this year or last year, since that low point. And is now just barely, up 37%, matching utilities return, whereas technology is up 160, still pretty much 5 times the return of the energy sector. So it's got the better margin of safety because it doesn't have the big gains to pull back from. In fact, since this pullback started at the end of the year for the S&P, technology's been down quite a bit and energy's been up quite a bit, right? So again, why? Because it's got even a better margin of safety than the safety sectors do because of how little of a return it had over such a bullish time frame. All right, now let's take a look at our trade idea of the day. And this is one of those thoughts I was telling you about before. They had a really good bullish move off of these recent lows. I mean, we were over 20%. Delta was over 20% below its 30-day moving average. Got back up towards the moving average, never could get quite above it. And now we're back to dark pink shading and the red line. Market sentiment still falling. And intermediate line's above it, but just barely. And the near-term line, momentum line dropping back down, out of bullish levels. When you take a look at like the long-term crossover, we had such a bearish candle that it's kind of hard to maintain, that strong bearish moves. You can see you kind of slow down, but you still end up pretty much testing the lows. After you get these big candles, you end up testing the lows again. That's kind of what I expect we'll see here. End up testing the lows of that big, long, lower candle. When you look at the moving averages, it did not get up. It barely got above the 17. It hit some resistance at this volume node, just barely above the point of control. So getting back below the 17 also means getting back below the value area of the 1 year chart. We have been in a death cross environment for a long time. Multiple tests of the 200-day moving average. 30-day has crossed back below the 50-day. The 8-day never did cross above the 17. That's where the MACD gets positive, and you already have the histogram falling. So good opportunity for the stock to maybe hit some resistance and roll over. The positive indicator got above 20, but never got above 25. The negative indicator never came close to dropping below 25. When you look at the RSI and the CCI, again, hitting those same ceilings, just a little bit above 50, not getting above 100, and they're already starting to roll over. Now you look at the Ichimoku cloud, we are still below the cloud, holding that blue line for resistance, even though we don't have the trend going. So we have the potential of starting a new trend. You can see we did get up to the midpoint of the bandwidth, really a big bandwidth. But so far, again, that's all we have, and you can see how dangerous we are with that value area sitting right there. From a Fibonacci retracement standpoint on this bearish run, we pretty much got up to the 50% retracement. Again, breaking back below the 38 would also be breaking back below, and then you've also got the next layer there. Things can get pretty bearish pretty quickly on Delta if this resistance holds. So it's a little bit of a speculative trade, so we're going to treat it that way. So I'm going to come over here to its options chain, come out to April expiration, and instead of buying at the money, which is a little bit more higher probability, I'm going to buy out of the money and sell right where that 1 standard deviation move is. So this is our max gain is right on the edge of the 1 standard deviation. So it's a little bit more speculative, but it's a very small risk for a very big reward. So about pretty much a 4-to-1, better than 4-to-1 reward to risk ratio in the worst case scenario. That's if we take maximum loss. Of course, if we break out to the upside on the stock, then we won't take, if we break up here above 37.5, then we won't take maximum loss, right? We'll just get out with about $200 reward. But $2,000 gain for pretty much a $200 risk, a 10-to-1 if it works out that way. Really, but it's very speculative, and again, it's banking on the fact that we're going to break back down below these levels and really pick up the speed to the downside, with considering that we're falling off of a pretty important shelf of a lot of support, a lot of resistance. We'll be holding resistance and breaking back down some important support levels. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also remember to subscribe to our website at marketscholars.com for free. And like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.